Welcome to another episode of the F Word Finance, where we talk about finance. We're in our offices here in Stellenbosch, and as luck would have it, we've got the leaf blower or the lawnmower going outside, but hopefully you can still hear us clearly. And today we are joined by Enrico from Allan Gray, and he's gonna tell us some key concepts around wealth creation and basically a foolproof plan, if I can call it that. It's simple, but it's not easy, and that's why I think a lot of people don't do it. But Enrico, welcome. It's nice to have you here.
Francois, thank you for having me. It's always a pleasure to be here.
Yeah, so Enrico, you've got 5 steps because there's many ways to create wealth. And create wealth is just like growing your net worth. So this year you are worth 10,000 Rand. Next year you are worth 15,000 Rand. And hopefully that trajectory go up. Even if it's just small amounts at the beginning, your net worth should increase. We've had our intern there at the back, Jensen. He is here, he's listening. But he then asked, how can you, as a young person, start early or start investing? And I think that's one of your key concepts, is starting early.
Yeah, so let's maybe holistically look at our core ingredients to wealth creation. So at Allan Gray, we think the most important thing to wealth creation is a combination of certain components. And that's a combination of how early you start, how much you contribute, the return you earn, how long you stay invested for, minus any withdrawals you might make. So your question regarding how can you start early and how can you make a meaningful impact on your investment returns? I think the hardest thing to do is get the discipline to start early. I think there's 2 components to starting early. It's the discipline and then the affordability. So maybe if you're a student, you can't always afford to put away 1,000 Rand a month. But if you can, the earlier you start, the better your outcome's going to be.
So that would be the minimum, mostly, like you say, 1,000 Rand, that's with Allan Gray. But most unit trust platforms is around 1,000 Rand, yeah. But I know it's not always possible for anyone. But that's where there are different platforms where you can I always say, just start with a habit. Even if it's 10 Rand a month, 10 Rand a week, you can just put away, gradually build that up. Then when you get to 1,000, you can put it into a unit trust. It's really just getting into that habit. I think that's the most important point, Francois, that we see with successful investment.
Yeah. I think you just gave us a very, very good explanation or example of someone that did that very well, starting early. But what I see a lot is people don't want to wait for their wealth to be created over a long-term period. I think social media has a lot to do with that, but maybe if you can just take us through one of these examples of starting early and what big impact it has on a client's future value.
Absolutely. So I think Warren Buffett was the example we discussed, and it's a phenomenal example. So he started investing at the age of 14. And what's interesting is that 99% of his net worth was accumulated after his 55th birthday. So his skill was investing, but his secret was time.
But like you say, most people don't want to wait till 55. And unfortunately, that is basically a foolproof plan. You will be guaranteed if you put away from, let's not say 14 because that's very young, but if you put away from 25 till the age of 65, guaranteed you'll have money. You're going to be wealthy. But the problem is people don't have the patience.
Yeah.
So they don't start necessarily. Or there's other get-rich-quick schemes that's faster or that promise faster.
Yeah.
But that's when we see so many people burn their fingers. And there's been schemes going around for decades, schemes going around now, schemes going to go on forever, and people still fall for that because they want that get rich quick.
Yes, I mean, I agree with you. The Warren Buffett example, I mean, it's conceptual to just illustrate the impact compound growth can have on your investment. But of course, it's not always practical for everyone to start investing at the age of 14. Perhaps a slightly more practical example would be the impact of contributing early towards your retirement. So by way of another example, if we look at the value of 1 Rand invested at different times, so we've got 3 investors. The first one's 25, second one's 35, third one's 45. All 3 of them are saving towards retirement to retire at the age of 65. The investor that invested his 1 Rand at the age of 25, by the time he retires 40 years later, that 1 Rand's now worth just over 30 Rand. Had he delayed it by 10 years and waited to save his 1 Rand from the age of 35, it would only have been worth 14 Rand. So that 10-year delay almost cuts his investment in half. So early contributions make a big impact.
And I think that's why a pension fund and a provident fund is actually so good for behavioral, because they force people. You belong to a company, your employer, you don't have a choice. So I'm taking 7.5%, 10% from your salary, I'm going to put it into a pension fund. And we definitely see those people one day, they are better off, because the people who's left to their own say they will do it, I'll do it next year, I'll do it one day. And they don't start, or they don't put as much away. So we definitely see that the pension fund, provident fund kind of creates that discipline to invest regularly.
Forced discipline.
But now, most people or people might listen to this and say, I'm not that young anymore. But there is other levers you have to your disposal as well. If you maybe didn't start that early, then you just need to put in more.
Yeah, so let's talk about the second component, how much you contribute. Obviously, the earlier you start, the smaller your contribution can be to get the required compound effect to help you achieve your financial goals of retirement. But if you're a little bit older and you start saving later, it's not that your goal becomes unattainable. It's just that you need to contribute a little bit more to achieve your requirements.
Yeah, so your contribution needs to make up the time lost.
Yes, correct.
In essence. And where do you see most of the gains being made over a time period? Is it sort of in the middle? Is it at the end? Where do people get most of their growth on their investments? So
interestingly, it's a concept I heard on one of your previous podcasts, was the rule of 72, to assert how often does your money double. And so you take the return you get and you divide it by 72, and that kind of gives you the amount of years. So if you get a 10% return every 7 years, your investment would double. So to answer your question, I think where you see the biggest impact of compound growth is towards the end of the journey. Of course, once you've accumulated a bigger amount, the double impact your investment has on your wealth starts massively accumulating.
It's really that snowball effect is what they call it.
Yes.
But if you see our snowball starts very small grain at the beginning, and that's where most people stop investing because they don't see a real difference. And then later it's a avalanche, and you just get, like you say, money doubles like every 5 years. If you've got a decent amount of money and that doubles every 5 years, that's definitely an avalanche, a positive avalanche that you want to be with. So that's 2 points. So first of all, you can start early. Second of all, it's how much you contribute. Okay. And then thirdly,
the return you earn. So what's interesting about the third ingredient, out of all the ingredients, this is the only one that you can't entirely control. You can influence it, but to a large extent, it's out of your control. So I would say there's three main components that influence the return that you earn. And that's your asset allocation, your diversification, and your risk management.
So in your opinion, and remember, viewers, this is not financial advice. In your opinion, someone that has a long term to invest, so we're talking 7 years plus, where should they probably look at investing? What are good types of funds for long term versus what are the mistakes that people make when investing long term?
So I think let's elaborate on asset allocation. So broadly speaking, you've got three main asset classes. You've got equities, which are shares, you get bonds, and you get cash. And that's kind of the risk spectrum from high risk to low risk, equities, bonds, cash. And if you look at those three asset classes over a very, very long period of time, over the last 100 years, what's quite obvious is that equities provide the greatest amount of real returns. And so when you're investing for a long period of time, the real returns become very important. So when I say real returns, I mean inflation beating returns.
And are these more volatile than bonds or cash instruments? Maybe you can give us a little bit of background on that as well.
Yes, so absolutely. The more risk you take on, the more volatility that comes with. So if you look at an asset class like equities, yes, over the long period of time, they provide you with a greater return, but those returns don't come in a straight line.
Yeah. If we just take COVID, for instance, the S&P down, 40 or 30% probably. 2021 also down 28%. Yet with all of those 2 years, in the last 7 years, you had your 15% plus return on the S&P over the longer period. But like you said, maybe you're going to come to it is, don't do stupid things when it's down. Don't
Yeah.
withdraw then or then want to move it, because
Yeah.
that's the biggest mistake
Yep.
people make, is changing their plan when there's panic. Which once again, it's simple, don't do it, but it's not easy. If you are there and it's your money that you're so hard work for, and once again, that's where the advisor real value comes to mind.
Yeah.
Because then you need to keep your client safe, calm.
So I have a question for you regarding the downturns, right? Do fund managers, does anyone actually know where the bottom of a downturn is or where the peak of the index is? Does anyone actually know?
So no, I don't think anyone's got a crystal ball to make those kind of predictions and assert what's going to happen. Maybe I can briefly touch on our investment philosophy and the way we approach things. So we've had the same investment philosophy for more than 50 years, which is incredible. And in a nutshell, we do our own in-house research to determine the intrinsic value of a company. We'll then do research on companies, look for good, high-quality businesses that are trading below the intrinsic value. We'll then buy those shares, wait for the companies to reach their intrinsic value, sell it off, rinse and repeat the process.
I'm not sure if you read that anchor report we get every month, and you can clearly see that the funds that's not doing well, then there's outflows, and then the funds who are doing well, then there's inflows. Like the investor behavior is just completely backwards. And we see, if we take Allan Gray for instance, then normally you have 2 or 3 good years, then you have 2 or 3 years that's maybe not as good, and people just switch at the wrong time. But over a long period, and you've, like you mentioned, you have performed over a long period. People shouldn't switch in and out.
No, so I've actually got an example on that, a hypothetical example, but I think it illustrates your point extremely well. So what we've done is we've taken the Allan Gray Balance Fund and we've looked at the fund over the time span from January 2020 all the way to January 2024. Now, there are 3 investors. The first investor invested in the Allan Gray Balance Fund and remained invested in the fund throughout the volatility of COVID for that 4-year period. The second investor invested in the money market fund, stayed in that fund throughout the 4-year period, and the third investor tried to time the pandemic, the COVID pandemic, and so the third investor switched out of the balance fund as the worst period around April 2020 of COVID occurred, and then tried to time switching back into it around April 2021. And there's quite a substantial impact on that. So the first investor that stayed invested within the fund would have had a return of 10.37%. And the second investor that stayed in the money market fund would have had a return of around 6%. And then the third investor who tried to time the market would have only had a return of around 4.3%.
Is that year on year?
No, so it's over a 4-year period. In rand terms, the market timing investor would have, so this is the impact on 100,000 rand, would have had 120,000 rand. The one that stayed in cash would have had 127,000 rand, and the one that remained invested in the balance fund, which is a high equity fund, would have had around 158,000 rand.
That's half, huh? Yeah. So that's destroying half of your money by trying to be clever. Let's not call it everything else, because that is exactly what it is. You know these guys, the toughest clients, because I know, I've got a client, someone that works in corporate, he tells me do this and this. Very clever people, but they make silly mistakes, and that's where wealth destruction comes in. And like I said, that's within your control. The markets are not within your control, but how you react, it's completely in your control. So once again, that's where just stay calm and play the long game.
Yeah, so that is the fourth component, how long you stay invested for, and how disciplined are you in sticking to your investment strategy.
But once again, it requires patience.
A lot of patience, and I think working with an independent financial advisor goes a long way, having someone to hold your hand throughout the process. I mean, I work within the industry, and when you see a market crash like COVID, having all the knowledge on, the impact of switching in and out of the markets, you still feel the emotion, so you don't become immune to the emotions of market crashes. So, I mean, the impact of those kind of things are real, and having someone that can coach you through it really goes a long way and has a big impact.
And time actually goes by fairly quickly. Yeah. If I tell you now in 5 years' time, you're guaranteed to have 100,000 rand, most will say, I don't want to wait so long. But now time goes by, you've done other things with your money or haven't invested, or you took a little bit of a chance, and then you come in that 5 years, now you only got 15,000 rand. Then you kick yourself for not doing that back then. because it went by so fast. When you're here, it sounds one far away, like retirement as well, but it creeps up on you quicker than you think.
Yep, 100%. I have a bit of a contentious issue that I need to bring up. You hear all these stories around the braai. Everybody's always got an opinion when it comes to markets and returns and all that stuff. What you guys do is basically long-term trading, buy an asset at a good price, and you think there's potential for the asset to grow. And then you've got active traders, daily traders, that make it seem as if it's extremely easy to trade. And I mean, you guys have got the best brains out there, actuarial scientists, all those guys. Why don't you do that for your clients if it's so easy to make double, triple digit returns for people, in a year?
Great question. So when you refer to active traders, would you then refer to someone like a day trader, someone that tries to profit off the markets through short-term trading, buying and selling numerous times?
Yeah, I think especially now you see a lot of them on Instagram, on social media, showing the houses, the cars. Is that the guys you're referring to? And then they're making, they're making money. I'm not sure what they're making money off of. Is it the client's money? Is it it? And then people fall for that, and then they invest their money. A recent one, maybe not bring in Klitterzone, but that was also something that, people see that short-term gain and they want to invest because they promise 15-20% return, but it doesn't exist. If it sounds too good to be true, you're not going to make money in the long term.
Yeah, so I think where we differ from that is that our core objective is to create long-term wealth for our clients, and we've done that by sticking to our investment philosophy, which is, as you mentioned, we'll buy a company that trades below its intrinsic value, but we typically have an outlook of around 4 years on a company, so our portfolio turnover is very low. So yes, we do trade, but it's not day trading. We don't frequently buy in and out of stocks and try and time any particular mispricement in the market, etc.
Yeah, because you get clients with their own portfolios, investment portfolios, or share portfolios, and then they will only tell you about the one or two that they got right. They won't tell you about the 5 or the 10 that they go wrong. So, and when you actively trade, like Francis said, you've got the best brains out there. It's not that easy just to quickly make a buck or two.
Absolutely. I would be very cautious when someone guarantees or promises a high return on an investment, especially if they don't have a track record to back it. If that's just a guarantee that's placed into the sky without anything to substantiate it. So I would encourage anyone to really do good research before you consider these kind of instruments.
So if you say promises of high returns, what in your opinion is a high return? Do you think it's close to 15% plus, 10% plus? Because that's always a little bit, because you can buy bonds, a 2040 bond that offers a yield of close to 11% right now, and that's quite a safe investment. And then you get guys that move the needle a little bit, and then they start going to the 13.5%, 15% guaranteed rates and all that stuff. So where do you think it becomes a little bit tricky, where people need to go, oh, that sounds a little bit much?
So maybe as a reference point, I would think of something like the Allan Gray Balance Fund, which is a high equity, moderately aggressive investment. And if you look at the long-term returns for the Allan Gray Balance Fund, which is just almost 25 years track record, it's around 14%, between 14 and 15% over a very long period of time. So I think that's maybe a good reference point if you consider what is a high return.
But with the interest rates being so high, that's what the banks did, and they advertised you can get 13% guaranteed, but that was the nominal return, not the real return. So people this is where tax planning comes into place as well, because then let's put money in the bank, I get my 15%, but oh no, I have to pay 45% tax on that, so my real return is actually only 7%. And I think that's where also people that's where you need an advisor, or someone that actually knows what to look out for. Yeah. So just on another note. Okay, so that's point number 4, staying in the market for the longer time.
Yes, and then the last point, so this recipe is all adding the different components. The last component is subtracting any withdrawals you make. And I think that's quite obvious. Any withdrawal you make from your investment during your journey is going to have a substantial impact on the outcome. So, I mean, everyone requires certain income to go and cover their essential expenses and those kind of things. So there's nothing wrong with making withdrawals from your investment, but it needs to be carefully considered and ensure that it's within your,
When we talk about the withdrawals out of the investment, it's actually very funny because it hits home. My wife just wants to go on holiday now. And she sort of asked, listen, can we take something out of the investment? And our investment, it's got another goal. But long story short, there's always the opportunity cost of that. So now we're sort of in a little bit of a stalemate with that one. But the opportunity cost is huge when you withdraw, especially if you're looking, over a 10-year period, what that 50 or 100 or 200,000 rand could be over a long-term period. So that makes 100% sense.
So are you not going on holiday now?
We are definitely going on holiday.
No,
My wife said we're going on holiday.
But I think,
we're going on holiday.
and I'm a financial advisor, and I would urge anyone to save as much or invest as much as possible. But I think you need to enjoy your money, and there's a fine line. I think because then you're also not winning the money game. Because I know a lot of people, they're just putting money away, but they're miserable and still so they're so fearful of losing their money. So it's also not serving them. So I think it's definitely finding that balance, and make it personal for you and your wife or your family. What do you like doing? Maybe that would be the best investment you would ever make, is going on that holiday, and it sparks your relationship, whatever. It's just an example. There can be other things. It can actually be a good investment in other areas in your life as well. So I think it's also, enjoy your money, make sure you put enough away, and then, but make sure it's personal for you.
Morgan Housel's got a great podcast called The Art of Spending Money, and it touches exactly on that point that you made. In this podcast, he actually mentions that it's quite a common problem for retirees who've spent their entire lives accumulating and saving, and now once they reach the point of retirement, it's very difficult for them to start spending that money.
Or they want to leave it for the kids. And I'm like, you worked so hard, they don't want to go on holiday because they want to leave money for the kids. I mean, that shouldn't be that way. Let the kids have enough time to work for themselves. Once again, it's a fine line. It's not advice we're giving you. It's just like we see all of these different scenarios play off. Okay, great. So just quickly recap that 5.
So the core ingredients to wealth creation is how early you start, how much you contribute, the return that you earn, how long you stay invested for, minus any withdrawals that you make.
Brilliant.
As you mentioned, 4 of those 5 are 100% within your control, and the other one are a little bit in your control as well.
Absolutely. You can influence it, you can have an impact on it, but to a large extent, it's entirely out of
And that
control.
is almost a guaranteed way. It's not easy, once again, it's simple, but it's not easy because it takes time and discipline.
And it's long-term wealth creation.
And I think an important note on this recipe as well is that there's no prescribed recipe for everyone, no prescribed amount of money that is going to make this recipe work for everyone. It's very individualized depending on what your goals are, what you're trying to achieve. So this might look very different for 2 different people, but the principle is, I think, what's the most important thing.
Lovely.
Nice. Thank you, Enrico. Appreciate it.
Thank you, Francois.
Thank you,
As
Enrico.
always.
This is awesome.